What's up, everyone? Welcome to the daily macro update for Wednesday, November 5th. Taking a look at some of the macro data here today, we have an interesting headline here. So, when it comes to the markets right now, what we're seeing is an acceleration in things that are not as bad in the macro, meaning that the jobs numbers are settling down, as well as we're starting to see leading economic data show that the economy isn't as bad as what has been previously thought. And so inflation expectations are rising, as well as growth isn't falling as fast as previously thought, which means that the Fed could slow the pace of rate cuts from here. Taking a look at the macro data from today, we can see that the ADP jobs number came out. So this is the private report. Since we don't have the data from the government, since they're going on day 40 or day 35 of the government shutdown, the longest government shutdown in history. But when taking a look at the jobs numbers for the ADP, we saw that they added 42,000 jobs in the month of October. This is a very large rebound from the negative 32,000 jobs that we saw in September. And also as well, when taking a look at the ISM Services PMI, this was the highest ISM Services PMI since February of this year. So taking a look at that number here, we can see that this is a pretty high acceleration, the highest since February. Even though, the past 6 months haven't been that impressive, this was a pretty large acceleration. When taking a look at the preferred components, when looking at the ISM services, we can see that prices remain elevated, mainly due to tariffs, right? So price inflation is not going away. But at the same time, we saw a large spike in new orders. So demand had a large acceleration. And then also as well, when taking a look at services employment, we see a 3-month acceleration from there. And this is important to look at services. And in my team's view, the ISM Services PMI is one of the most important monthly leading economic indicators there is, because the United States economy is based on a services economy, not so much a goods economy. And so when it comes to comparing either services PMIs or manufacturing PMIs, services are the most important one. And so with services accelerating, the jobs numbers, having a decent rebound, as well as when taking a look at inflation expectations, the preferred metric that my team and I like to look at is the 5-year break-even inflation rate. We can see that that also had a large jump from the October 17th low. And so we have hard data as well as the bond market pricing in that we could be in this stagflationary type of environment still. And so what does well in that? Well, we could see a further rebound in gold, with gold continuing its trend here. And so, as we can see, we've had a pretty decent rebound today in things like gold miners, silver, copper miners. And when taking a look at gold itself, it is finding a little bit of a floor here. Now, my team and I still own gold, but we've been having it at a minimum position right now until we see a comeback with volume, which we haven't yet seen so far. It could. We just have to have more confirmation here. But when taking a look at the GLD ETF, which is my team's preferred gold ETF for paper exposure to gold, we can see that pretty much over the past couple weeks, we've seen a large drop off in volume. And so if prices are declining on lower volume, that is a classic bearish divergence. From here, what you would want to see in order to confirm some type of reversal is a pop-up in gold's price, preferably near the top end of the trading range on higher volume. At that point, you would want to look for a correction on lower volume, and then that would be your execution back to adding gold price or adding to gold there. Haven't seen that just yet, so still remaining patient on that. But it is interesting how we're in this new environment where, you have a very strong bullish dollar. You have bond yields signaling stickier inflation, as well as potentially, stagnant growth. And then also at the same time, you have liquidity conditions remaining extremely tight. Now, this is something that is definitely part of a later stage point in the cycle. And, this is something where you have to be pretty strategic and not just buy every single dip that you see that's out there. As of the recording of this video too, we have not all of the sectors in the S&P 500 in bullish trend. Really, from what my team and I track, the sectors that are remaining in bullish trend within the S&P is tech, healthcare, utilities, as well as discretionary, as well as industrial. So those are the ones that we see that are remaining in bullish trend. The others are remaining in bearish trend. So those are things like materials, energy. We also have financials, staples, and real estate. So not so much a consensus from the 11 sectors on a bullish market. So you have to be pretty selective on where you have potential exposure to. And so what this all says is that there could be not as many price or rate cuts in, let me back up. So what this could mean is that there may not be as many rate cuts being priced in for the year of 2026. And because of that, and with the market over the past few months obsessing over rate cuts, this could obviously cause a delay in liquidity sensitive assets such as cryptocurrencies, which we've seen, over the past few trading days have had a large decline. Looking at things like Bitcoin, although it has had a little bit of a settling down here around 100K, had a decent bounce there. And right now, even today, it's having a bounce. When you have these types of environments where people are fleeing to, bonds, the dollar, very liquid assets like gold, that tends to be a warning sign for super risk on assets that are liquidity sensitive, such as the cryptocurrency markets. So ultimately, this is another iteration of the doom loop that we've been experiencing over the past, 3 years, where the stock market will go up, then inflation expectations will remain sticky. This causes the Fed to remain or be a little bit more hawkish. This then causes stocks to sell off a little bit, and then inflation starts to come down. The Fed gets worried, and then so they cut rates, and then the market goes back up, and the whole cycle repeats itself. And we really haven't broken this trend, although I think that we're starting to see a little bit of cracks, specifically when it comes to the liquidity machine that's been fueling that, seeing that, the reverse repo facility is out of money, as well as, we're really starting to see a change in the liquidity dynamic with the Fed stopping their quantitative tightening practice. So, ultimately they're running out of methods when it comes to shoring up liquidity. And I think that it'll get to a point where there will be some reconciliation and we will see a large correction in the markets, but there's no point in trying to call when or the magnitude of how that will happen. And so, the volatility index of the S&P 500 remains, below 18, which is typically a great time to be holding on to assets that are in bullish trend. With it over the past couple days around 18 and 19, that showed to be a pretty good opportunity to look for dips to buy. And so for those who are in our macro investing community, you saw that we were buying some things that were having a dip there, and there was plenty of opportunities. So hopefully you didn't get scared just because, the markets were saying, oh man, the sky's going to fall again. And you were able to just look at what type of regime we are in and follow a process. If not, that's what we go through in our macro investing community. And right now we are still doing our 6-week challenge between now and the end of the year. So if you'd like to learn our process, learn macro, as well as see the exact assets that my team and I are bullish or bearish, you can go ahead and schedule a time with me on my calendar where you and I will have a discussion about the details of the 6-week challenge. And it's really just a casual conversation around, what you're trying to get out of this game that is investing. And so that's pretty much what I'm seeing here in the markets. When taking a look at the yield curve, we continue to see, let me back up a little bit. Taking a look at the yield curve, we continue to see it's maintaining its flatness ever since the middle of April there. And so with the yield curve, what's called bull flattening, this is typically signaling that we are in this later stage where we have more weak growth. Most of it is coming from the government issuing debt. And so when you have growth mainly coming from debt issuance and not actual productivity, that is a problem. And typically and historically, after a bull flattening, this tends to steepen because something breaks in the economy. And so, we've seen this happen in cycles prior where the Fed will start to try and cut rates easy and try and, achieve that that soft landing. But sometimes it doesn't happen. Actually, historically, the majority of time it doesn't happen, and the market ends up slipping because, the reason why they're starting to incrementally cut rates is for a reason. And that reason is because they're starting to see weakness in the jobs market. They're starting to see weakness in the actual, aggregate economy that we haven't seen over the past few years. And so, the Fed is in a very difficult position right now where you're still experiencing this type of K-shaped economy where people who own assets and have high incomes are doing very well. But those people who are, more that have more consumer debt and aren't making as much and don't own assets, they are struggling right now and have been in a recession over the past 3 years or so. And so what does the Fed do? Do they cut rates from here and cause asset prices, which are already at all-time highs, to continue higher, furthering that K-shaped economy inevitably? Or do they remain tight and wait until something cracks? And so with that in mind, I don't think there is any type of win-win scenario that the Fed is looking at here in the medium term. And I do think because they're trying to do this method where they cut interest rates a little bit incrementally and then they stop, then they cut a little bit and stop. I think ultimately because when you take a look at the average interest rate from right now compared to the last 15 years, it's a lot higher, right? It's a lot higher than zero. This is going to cause some issues. And I think the liquidity from the pandemic is still running around in the financial markets, and it's coming to a close soon. So that's pretty much what we will see here in the next 12 months, how all that plays out. But we're going to go ahead and get into some of the questions here. The market just closed, and yeah, we can get into some questions. At the timing of this recording, there is a 60-40% chance of a 25 basis point cut for the December 10th meeting happening in just a few short weeks. This was just a 70-30 split just 24 hours ago. And so as you can see, with inflation expectations rising, as well as when we get better than expected real economic data, that the futures market is saying, why should the Fed cut rates if things aren't as bad as what they initially thought? And so if we continue to get this type of data, which hopefully soon the government can come out of shutdown and provide us with actual real government data, then we can get more clarity on if the Fed is going to cut rates. But as of right now, if we continue to get this type of data from the bond market as well as from the real market in the private data, then I wouldn't be surprised if they do pause in December, because that's really where the trend is shifting here. So I wouldn't be surprised in the next few days that this goes to a 50-50 probability, a 50% chance of a 25 basis point cut or a 50% chance of a pause. And so that's why liquidity sensitive assets like Bitcoin have started to sell off from here, because it was expecting QE infinity. So that's really the big market shift that's been happening over the past 48 hours. But let's go ahead and get into some questions here. I appreciate everyone for joining. How's everyone doing on this fine Wednesday? Let me take a sip of water. Let's go ahead and take a look at some of the comments on TikTok here. Just scrolling through them. Jack Hammer asks, quantitative easing on December 1st week. Is that correct news? I'm not sure what you're asking. Are you asking that you saw something that they're going to be doing QE on December 1st? Oh, I know what you're referring to. You're talking about the ending of quantitative tightening. Yeah, so when it comes to the Fed's policy with quantitative easing versus quantitative tightening, you have to understand something. And let me see if I can pull up a chart here. Yeah, because this is an important distinction here. Let me see if I can. Let me see here. I'm trying to pull up an interesting chart. Yeah, it doesn't look like there's any interesting charts that I can pull up as I describe this. Well, I guess the chart that I can pull up is the Fed's balance sheet here. So let me see. One second. All right, here we go. All right, so this chart right here is the assets that are held on the Fed's balance sheet. And this is where, quantitative tightening versus quantitative easing comes into play, right? So the reason why the Fed has been doing what's called quantitative tightening or reducing assets on their balance sheet, we saw that pretty much from where it peaked out here in June of 2022, the Fed has been letting assets on their balance sheet roll off, meaning that the longer duration bonds that they have, the debt, when they mature and expire, they are not repurchasing that debt. They are letting it roll off, expire, and they're not doing anything with it. This is different from completely just selling assets on their balance sheet. They're not doing that. That would be like anti-quantitative easing. But quantitative tightening is just letting balance sheet roll off happen. Now, the pace at which this is happening has been changing pretty much since May of last year in 2024. This is where they slowed the pace of quantitative tightening, and they've been guiding this. So as you can see, I can put some, white horizontal lines here. See how that was the current rate of change of quantitative tightening. Then from, May of 2024, they, reduced the pace of letting these assets roll off their balance sheet. And in order to do that, instead of letting, let's just say, $500 billion roll off, then maybe you take some of that principal and then you buy more, duration assets in order to offset it. So this is where they were doing less QT, and they were actually starting to buy, certain treasury securities. And now that pace has, flattened a lot since then. On March of this year, they, slowed the pace even again. And as they're slowing the pace of quantitative tightening, this is because they are starting to see cracks in the liquidity markets. One thing that I can pull up as well on top of this is the reverse repo facility. So let me just bring that up on a new scale here. So as you can see, in blue here, this is the reverse repo facility. Right now, it's currently at around 19 billion, but just as when the Fed was performing quantitative tightening, this was around 2 trillion. And so I'm going to invert this chart just to show you exactly, what was going on here. And so as the Fed was letting assets roll off their balance sheet, all of the money that was stored up from the pandemic, right? So a lot of the excess liquidity got thrown into this giant parking lot at the Federal Reserve called the reverse repo facility. All of the trillions of dollars from there, as the Fed was rolling assets off their balance sheet, that was being injected into the markets, effectively canceling out the effects of quantitative tightening. So even though the Fed said that they were, removing assets on their balance sheet, they were counteracting the effects of that with strategically draining the reverse repo facility. And so effectively their QT was being canceled out. That's part of the reason why you had the markets perform very well over the past few years, is because there wasn't really being assets drained from the system. It was being canceled out here. And so now with the change of pace, as you can see, the change of pace in the reverse repo facility, that drain, as that slowed down, that's why the Fed had to reduce the rate at which they were letting assets roll off their balance sheet, because the reverse repo facility was starting to slow down as well with its injection. And now it's at a point where there is no more money left in the reverse repo facility. And so that's why the Fed has said, hey, we're not getting that counterbalance effect anymore. We're going to have to stop QT, because that would actually cause ample reserves to go into scarcity, which in that case, that would really cause the markets to have a convulsion and, potentially puke up. And so that's not what they're trying to do. Now, this is very strategic and a coordination between the Treasury Department over at the government as well as the Federal Reserve. They say that they're independent entities. That's technically true, but they do work together, and they've been doing that ever since the inception of the Federal Reserve all the way back in 1913. And so now we're at a point where, since there's no more liquidity left in the RRP, so all the pandemic money is drained out, what happens from here? Well, when taking a look at what's left in terms of net central bank liquidity, we can see that right now, as of the recording of this video, there is nearly $1 trillion that's stored up in the Treasury General Account, which is essentially the Fed's, or the government's checking account that's held at the Fed. This could be used as emergency liquidity, but is very temporary and is mainly used for obligations for the government, not necessarily flooding the markets with liquidity. Although, when this does get drained, it does tend to provide more liquidity support with the markets. So there's about $1 trillion left in the TGA that could support this temporarily. So the Fed is not out of liquidity tools, which could, float the markets well into 2026 from here. But once that gets drained, you could really run into some problems, because the majority of the money that the government wants to use in the TGA is to help out with what's called rollover risk, which is all of the money that's being printed by the government by issuing debt over the past few years. As we know, hopefully by now, that's because the Fed or the government has been issuing shorter duration bills, meaning all of the Treasury issuance, all the debt being issued, is very short term, right? These are bills that have anywhere between, a few weeks before they mature, or an entire year. And so what happens is, over these past 3 years, as as the government continues to issue this short duration debt, you not only have to have demand for it, but also too, when they mature, the government is responsible for rolling over that debt. And so it becomes much harder, and the rollover risk increases the more short duration debt you issue. And so this is meant to be a temporary thing that the government is doing until rates get lowered. But it's coming to a apex here, because you can't get lower rates unless you have some type of real slowdown in the economy. And that soft landing is something that it might not be possible. It could be, who knows, only time will tell. But all this to say is that the government and the Fed are running out of tools in order to shore up liquidity. And I think that's why you're getting this type of sell-off in Bitcoin as a front-running signal, right? Because my team and I, in terms of a macro indicator, Bitcoin is a very good macro indicator for financial market liquidity. When liquidity is abundant, that's typically when Bitcoin does incredibly well. When the rate of change is slowing down, that's when Bitcoin can kind of chop sideways, kind of like it's been doing over the past 4 or 5 months. And then when the rate of change of liquidity starts to decline, which if we take a look at the actual net central bank liquidity measurement right here, you can see that ever since the beginning of August, this has had a large drop off. And if you guys have been watching the videos over the past few weeks, you've heard me talk about how, we've been seeing this alligator mouth open up with Bitcoin compared to net central bank liquidity, and that something was going to give. And so, if you've been watching this channel, you should not be surprised that we've been seeing a large correction in Bitcoin over the past few days, right? So this is a chart here that shows Bitcoin in blue and net central bank liquidity in orange here. And so, could this mean that, Bitcoin could go down further in price? Possibly, but that has yet to play out. But one thing's for certain is that I'm steering clear of hyper liquidity sensitive assets like Bitcoin when we are entering into this liquidity turbulent type of environment. Things like gold, things like the dollar are, bullish right now for a reason. Now, that doesn't mean that just because they're ending QT does not mean that they are going full blown into quantitative easing, because quantitative easing is when they actually start to add assets on their balance sheet. And this ending of QT, they still want to maintain that neutral or neutrality, right? Beforehand, they were able to reduce assets on their balance sheet while at the same time liquidity from the RRP was coming in. Now that the RRP is drained, when assets continue to roll off their balance sheet, they are then taking that principal and fully reinvesting that into shorter duration bills. And so a lot of people have been confusing this with full-blown quantitative easing when that's not the case. The Fed just wants to maintain ample liquidity levels. They don't want to add right now because they know that if they add, this will definitely cause inflation to go up even further than what it is right now. And so the Fed is really stuck between a rock and a hard place with this, but they are going to try and maintain this net neutrality with ample reserves and ample liquidity for as long as possible. And so I think, in this environment, things that typically perform well are, things like gold, the Mag 7 stocks, pretty much, things that everybody owns in their 401ks and things like that. And you could find some pockets of different sectors and industries that do well from here too. You have to pay attention to what's actually bullish on a more sustained trend. But yeah, just because the Fed stopped quantitative tightening does not mean that they're going full-blown quantitative easing. That would be when we see their balance sheet here. This is where we would see their balance sheet, the assets on their balance sheet start to rise, similar to what we saw back, in early 2019. So that has not happened yet. What will happen from here is, for as long as possible, the assets on the Fed's balance sheet will look like that. I try to make it straight. Let me hit shift. Yeah, just like that. Now, at some point again, something will break and the Fed is ultimately going to add assets back on their balance sheet. And when that happens, looking at the red arrow there, that will be quantitative easing. And typically, in that environment, that's typically when something breaks in the market and the Fed has to come into the rescue. And so you might have a short-term correction in the markets. I don't know at what magnitude or what time that will happen, but you will have different types of warnings before that actually goes through. So I know that was a long-winded answer, but just know that this ending of quantitative tightening does not mean a beginning of quantitative easing. Appreciate the shares. Appreciate the likes, everyone. Hopefully you are enjoying this content. Are Bitcoin miners still worth it, even if Bitcoin price goes down? That's a great question too. So let me pull up this real quick. Okay, just pulling up these different charts here. Let me change this color to orange because Bitcoin's orange. All right, so the question was, are Bitcoin miners still worth it even if Bitcoin's price goes down? That's a great question. Taking a look at the chart here, we have the Bitcoin miner ETF WGMI in candles, and then you have, contrast to that, Bitcoin's price in orange, this orange line here. And so as you can see, typically, you're correct in thinking that, Bitcoin as well as Bitcoin miners are relatively correlated in a positive way, which they definitely are. And so, with Bitcoin's price going sideways, why is Bitcoin miners, going up in price? And should it be something that we continuously own? Now, one thing, first and foremost, is that right now, Bitcoin miners remain bullish trend in our model, and the underlying asset, Bitcoin, is in a bearish trend. So obviously, there's a bit of a divergence there. But from what we've seen is that Bitcoin miners are starting to get more into the AI space with how they're being utilized. And so there is a little bit of the AI boom component that is shoring up the prices of Bitcoin miners. And so I think that it is riding the AI hype for now. And it is still something where, you could continue to keep buying dips. Now, with Bitcoin's price going bearish, I probably wouldn't be adding incredibly aggressive. I probably wouldn't be adding aggressively to Bitcoin miner stocks, but they remain in bullish trend, and so that means that continue to be long them, but be a little bit cautious as Bitcoin's price is now bearish here. But that's pretty much how my team and I are approaching it. But good question. Appreciate it. Appreciate it. Let's go over to Instagram here. What software do you use? Where do your charts come from? I'm using TradingView. So just go on Google and type in TradingView. What about stablecoin issuance? Does that act like QE at the Fed? No, I mean it's essentially just another pocket for liquidity to go. A lot of people think that this Trump administration is incredibly pro-crypto. What they're trying to do is, in this environment where liquidity is running out, they're trying to look for any type of methods where they can find pockets of cash. And so with stablecoins, it just happens to be something where, hey, if we mandate by law that stablecoin issuers have to back up their stablecoins with US treasuries and nothing else, well, that creates a lot of demand for bonds. And so, yes, on TV, they like to say, we're pro crypto, we're the most pro crypto administration ever. Well, it's because it's serving a purpose for them. And that is that it's a source of liquidity for them to continue to buy themselves time in this liquidity tight environment. Hopefully that makes sense. Good questions. Good questions. All right. Well, It's almost 4:30 here. We'll go ahead and wrap it up there. I appreciate everyone for joining. As always, if you guys would like to learn this stuff from my team, as well as learn all the different macro strategies that we use in our model, as well as in our community, right now we're doing a 6-week challenge where you can gain access to our partnership circle tier, and you can have access to our entire trainings. You can have access to all of the different list of stocks, ETFs, as well as other assets that we are long or short given the macro environment. And then also too, you have all of our different daily reports that we that are exclusive to just our community there. So if that's something that you would like to learn more about, then just go to the link in the description below. For those who are on YouTube, for those who are on Instagram or TikTok, go to the link in my bio there and you can book a call with me and we can review everything there. But I appreciate everyone for joining. Have a great rest of your Wednesday, and we will catch you in tomorrow's daily macro update. Bye, everyone.